Hello and welcome to today's quick, fast and super punchy video, which is called Enough Fear Already. Definitely, let's talk about yesterday's flash, whether it is still falling into the orderly category or whether we have seen enough of a volatility spike. This will be a quick, thorough 360-degree examination. Let's dive into the situation following Friday's close, where I had been noting down two resistance levels. We had as well seen this pre-market action, which I featured in yesterday's video at the moment of it being recorded. And together with that, I had been notifying clients about one major sectoral watchout, which I had my eyes on as to whether the short squeezy suspect technical rally of Friday's lows would last, would get prolonged, where it could reach, and so on. I will tell you what I had already said on my Twitter feed, and that is what made me worried as an additional clue to this premium clue was that Nasdaq lost its bout of outperformance of S&P 500 right following the opening bout, and the selling was pretty orderly and went just through Friday's lows in an instant, and it was one of those days when it's better not to be standing in the way. Have a look at this sectoral overview. Former leaders, communications, discretionaries and tech rolling over to the downside. Where are financials? Where are industrials? Where are materials? Bingo. Are defensives working? No, in such a high volatility. High, but is it extreme? Is it orderly? We will dive into that right away. Is that going to see significant enough inflows, or is it as well hit by that volatility spike, one that could be kind of called like that? Thank you for liking these videos and subscribing to the channel. I should have started with that, but never mind, I'm telling it now. Thanks again for liking these videos, it helps greatly. So, swing trading clients had been staying with the major trend and not trying to ride counter-trend bounces, whether they emerge off technically important levels when momentum and flow is starting to favor the bulls to put up some kind of a fight. And in bear down legs, those short squeezes can be really volatile, as we had seen Friday. One reminder, summing up all those reasons for the flash, and it was then when the floor started to give in under equities, when stagflationary data started to arrive and the index of positive economic surprises went downhill. I had been featuring that on the usual extensive weekend videos. What's the advantage of cleaning house early in one's term? And this is exactly what we are seeing happening, with all the bloat being cut off. And of course it has consequences for the real economy, consumer confidence, for the polarization, and those lofty PE, those lofty valuations, those drivers in MAX 7, and the heavy concentration risk is taking its toll. Record high uncertainty on the geopolitical scene as well. So that makes you worried as any other investor about future earnings, and you did not hear me utter the word tariffs yet. One more reminder as to the volatility-based approach to bottom calling. and the rhetoric question or remark as the final line regarding October 2022, there not being any volatility spike. So we will assess together in the few following charts. Thanks again for liking this video as to whether we are seeing one, whether that is still ahead or how it is looking. That was the Friday's close VIX chart. See upper knots, rejection, and I called for some backing and filling within this range. Same for VIX to short-term VIX, forward-looking VIX. This ratio is the one that I prefer somewhat more to the prior simple VIX, and you see similar rejection. However, I had been covering in the latest video, to which I will be linking as well, this backing and filling within the context, including the upper knot of Friday's candle in this ratio. Put to call ratio, Friday's close. Is this looking like an extreme fear? Not at all. There is no rush to the put side at all to be seen. Following yesterday's close, is this a significant enough rejection? Is the glass half full or half empty? This candle is showing you that it is still quite orderly ascent in volatility. The same thing is being said by S&P 500 daily volume. Is it getting worse or prior? Is it getting worse? I mean, attracting more buying and selling interest? Is the situation stabilizing, attention receding, or it is still somewhat being ratcheted up, those tensions? Here you can see quite perfect respect for that range and building up of that pressure. Compare to December FOMC. It is at this level. How does it compare? How does it stand versus early August 2024, the yen carry trade panic? That's another cup of tea entirely. Put to call ratio. Is this extreme fear? Is this looking like that? Why is it not spiking higher? Because implied volatility is through the roof and all the options are very expensive. It is not the best time to play this via options. You have to wait for volatility to peak and to start coming down. Only then your options, whether puts or calls, will start paying off better than they do now. My joint page to help you select what's right for you based on what and how you trade. I can't stress enough the importance of getting full access to my daily analytics delivered over my site right into your mailbox, and the premium intraday channels over Telegram. You know pretty well my journey and what it takes to break free from, say, finance industry operating standards. Obligatory disclaimer. Thank you and let's talk soon again.